Yes, students, now we will revise the assessment procedure topic, which is also called as returns. First, we will learn section 139 subsection 1, which talks about who is supposed to file the income tax returns compulsorily and within what time. First, we will understand who, then we will understand within what time, that is when. Yes, sir. So there are list of people who should mandatorily file income tax returns. It is given in the order here. And guys, please learn it in a sequence. For example, if I am a person who is covered here, then we need not check the remaining points. Or else, assume I am an individual who is covered in the second point. Should I check third, fourth, and fifth point? Not required. Okay, let us see one by one. First one, companies and partnership firm should always file their returns irrespective of whether they have income or whether they have loss, guys. It is mandatory for them to file the income tax returns. Okay. Then coming to the second set of people, a person other than a company and firm has to file the returns if their total income is more than basic exemption limit. And the basic exemption limit can be like 4 lakh or 2 lakh 50 or 3 lakh or 5 lakh, depending upon who is an assessee and which scheme they are following. Okay. Then an ordinary resident who is not covered in one or two point, but at any time during the previous year, if they are covered here, that is point A or B, they are supposed to file the returns in India, guys. So who is it? We will see. An ordinary resident who hold as a beneficial owner or otherwise any asset including financial interest located outside India or as a signing authority in any account located outside India. And please be careful, this is at any time. For example, assume I am holding the shares of a foreign company just for one day during the previous year. Am I covered in this point? Yes. Even if I am holding it for one day or few days during the previous year, I am covered in this point. Got it? Yes. Then B is a beneficiary of any asset, including any financial interest located outside India. Sir, what is beneficiary? Guys, I might not be the owner of an asset, but I derive a benefit from a particular asset or property. For example, assume my father own a property outside India and he has written a will in my name for that property. Or let us assume my grandfather has a life insurance policy outside India for which he has named me as a nominee. So am I a beneficiary? Yes, guys. Okay. Then coming to the fourth point, every person being an individual, HUF, EOP, BOI and artificial juridical person. In simple, I call them as slab rate associate, whose total income or someone else total income for which they are supposed to pay tax like clubbing and all without giving effect to the provisions of Chapter 6A deductions or exemption under Section 54, 54B, EC or F exceeds basic exemption limit, then they are compulsorily required to file the income tax return as per point 4, guys. This is a bit confusing. I will try to explain it with an example. Now assume guys, I am an individual whose total income is more than basic exemption limit. Should I file the income tax returns? Yes, of course I have to file as per this point. As per this point. Okay. Whereas, let me take the next example. Assume a gross total income of an individual is 8 lakh and he has claimed deductions under chapter 6A, all sections put together 6 lakh. So now after claiming deduction, his total income is 2 lakh, which is less than basic exemption limit. It is less than basic exemption limit. Okay. Now what they are asking in fourth point is whatever deductions in is claimed under chapter 6A, just add it back. Just add it back. Okay. Only for this purpose, add it back and check what is that figure. 8 lakh. And we don't call this as a total income. Please be careful. Okay. If this figure is more than basic exemption limit, they have to file income tax returns. That means, sir, are they asking us to pay tax on the deductions also? No, no, no. Assessee need not pay tax because the total income is less than basic essential limit. But here, they're just asking you to add back the deduction and check whether it is more than basic exemption limit. And if yes, they have to file income tax returns, guys. Okay, sir. Then one more example. Assume assessee has claimed exemption under section 54 in capital gains head for 25 lakh and after claiming this exemption, the total income is coming to 2.2 lakh, which is less than basic exemption limit. Okay. But as per point number 4, which we are learning now, they're asking us to add back this exemption. Okay. So this figure comes to how much? 27 lakh 20,000. And it is more than basic exemption limit. Should assessee file the income tax returns? Yes. Their tax liability might be zero because total income is less than basic exemption limit. But are they supposed to file the income tax returns? Yes, guys. As per point number 4 here. Hope you got it. Yes, sir. Then fifth point, the last one. And you will check fifth point as I already mentioned you, only if assess is not covered in first four points, guys. So go in a sequence. Clear? So I will go and check fifth point only if I am not covered in the first four. Okay. Let me read it. Any person other than the company or a firm, because company and a firm is always supposed to file their returns. Okay, is required to file the return if during the previous year such person is covered under any of these 3 points. What are those? One by one. First, has deposited an amount of more than 1 crore in one or more current accounts maintained with a banking company or a cooperative bank. In one or more current account, guys. And please be careful here, what is covered is current account. For example, assume I have only one current account. I have deposited 50 lakh or 60 lakhs during the year. Am I covered here? No. Now assume I have a two current account and I have deposited 60 lakh in each of the account. Aggregate is how much? 1.2 crore, which is more than 1 crore. Should I file the returns mandatorily? Yes. Aggregate should be more than 1 crore. Then a person is covered here. If it is less than or equal to 1 crore, then no, he is not covered here, guys. He is not required to file the returns. Okay, provided he is not covered under other points. Oh. Second point, has incurred a foreign travel expenditure of more than 2 lakhs for himself or any other person. Foreign travel expenditure for himself or any of their family members or anyone. If he has incurred more than 2 lakh, then he is covered here. The last point, has incurred an electricity expenditure of more than 1 lakh in a year. You might pay electricity bill every month, but you need to check it for aggregate in a year. If it is more than 1 lakh, then assessee is covered here. That means they are supposed to file income tax returns. And please be careful. Sir, should assessee be covered in all the 3 points? No, no, no. Any one of them here. Clear? In between or is there. Please be careful. Yes. And the last point they told, fulfills such other prescribed conditions. For this purpose, the government has added a rule, that is rule 12AB. Okay, what is it? We will see. Guys, please be careful. You will check the rule only if an assessee is not covered under any of this point. If an assessee is already covered under any of these points, then no need to check the rule, guys. Okay, so what is rule telling? We will see. Rule 12AB has been inserted to prescribe the following other conditions for furnishing the return under section 139 subsection 1. Means if a person is covered under any of this point also, he has to file the income tax returns mandatorily, guys. So who are those? We will see one by one. A person who is carrying on the business, if its total sales turnover or gross receipts during the previous year is more than 60 lakhs, irrespective of their income, whether they have income or loss. Then a person carrying on a profession, if their total receipts, that is gross receipts during the previous year is more than 10 lakh. And please be careful, guys. Here a person will not include company and partnership firm, because company and partnership firm is always covered here. Whereas for others, we need to check these 4 points. No, if they are not covered under any of these 4 points, then you can check this. What is the turnover or gross receipts from their business or profession, guys? Or then a resident individual who is aged 60 or more at any time during the relevant previous year, and if the aggregate amount of TDS as well as TCS, all sections put together, is more than or equal to 50,000 during the previous year, they are supposed to file the returns. Whereas for others, means other than who is covered here, the amount limit is 25,000, that is half of 50,000. So if TDS and TCS all put together, if it is 25,000 or more during the previous year, then they have to file the income tax returns, guys. Then the last person, a person who is having a savings bank account and is depositing in one or more savings bank account of rupees 50 lakh or more during the previous year, they have to file the returns. And please be careful, what is covered here is savings bank account. And what was covered here was current account and the limit was 1 crore. Whereas here it is savings bank account and the limit here is 50 lakhs, guys. Clear. For example, assume I have three savings account and in each of the account I am depositing 20 lakh each. What is the aggregate amount, guys? 60 lakh. And 60 lakh is more than 50 lakh. Should I file the returns? Yes, I should. Okay. So till now, what we learned is who should file the income tax returns compulsorily under income tax law as per section 139 subsection 1. Once we understand who should file, now let us learn within what time should they file, sir. That is when, which is given in section 139 subsection 1, same section. Okay. So what is the due date to file income tax return? Guys, very important because this section or this provision has been referred to in many other topics also, especially in PGBP chapter. Oh, fine. Let us see what is it. Due date for filing the income tax returns 30th November of the assessment year for an assessee who is required to furnish transfer pricing report under section 92E. And this is for the assessee who is engaged in international transactions, guys. And transfer pricing report is not a part of your syllabus. You need not worry. But you should know that an assessee who is supposed to submit transfer pricing report under section 92E, for him, the due date to file income tax return is 30th November of assessment year. Then second list, 31st October of the assessment year in case of an assessee who is a company, always covered here. Then for others who is subject to tax audit under section 44AB. Let me read it. A person other than a company whose accounts are required to be audited as per section 44AB, which we learnt in PGBP chapter, or a working partner of a firm whose accounts are required to be audited. So company always, whereas for others who is subject to tax audit. Okay, and whenever tax audit is applicable as per section 44AB, a chartered accountant in practice has to be appointed and a report of tax audit has to be submitted 1 month prior to the due date of filing the income tax returns, guys. So when audit is applicable, the due date to file returns is 31st October. So 1 month prior to that means on or before 30th September, a copy of tax audit report has to be furnished. Okay. Then any other case means whoever is not covered in 1 and B, sorry, A and B, they will fall under last category. That is 31st July of the assessment year in case of any other assessee who has only salary income or house property income and who is not subject to tax audit. Got it? Yes, sir. Then even if an assessee has a loss which he wants to carry forward and adjust it in the future, he has to file loss returns, guys. And within what time, sir? Within the time given here. Even loss returns has to be filed within the due date mentioned here. Okay. If an assessee doesn't file loss returns, then he cannot carry forward the loss. But exception is house property loss and unobserved depreciation. These two laws he can carry forward even if return is not filed within due date. Whereas if he wants to carry forward any other loss, he has to file the loss returns within the due date, or else he will lose that benefit. Okay. Next, belated return is covered under section 139 subsection 4. Belated return is when the assessee has failed to file the returns within the due date. So what is the due date? We already learned. But if assessee has failed to file the returns within the due date, can he still file later? Yes. Within what time? A return which has not been furnished within the time allowed under section 139 subsection 1, that is due date, may be furnished at any time. Within what time? Before 3 months prior to the end of relevant assessment year. Okay, end of assessment year is 31st March. 3 months before that means 31st December, guys. So 31st December of assessment year. So for previous year 25-26, it would be the 31st December 2026. In simple, 31st December of assessment year or completion of assessment, whichever is earlier. And if by chance, if this date is not given, always take it as 31st December 2026. That is 31st December of assessment year for your exams. Okay. Sir, can an assessee file revised return under section 139 subsection 5? Yes, is allowed. Now, if an assessee has already filed the return, whether within the due date or after the due date, that is belated return, he can revise it if there is any omission or if there is any mistake, guys. And within what time, sir? Same timeline. Whatever same timeline we saw for belated return, no, same timeline. Sir, can even belated return be revised? Yes, even belated return can be revised, but within this deadline. That is 31st December of the assessment year or the date of completion of assessment, whichever is earlier, guys. Clear? And sir, how many times a return can be revised? It can be revised any number of times. Any number of time, guys. Yes. And there are some consequences for an assessee who files belated return. That is, if he has not filed the returns within the due date, he can file the returns after the due date, but obviously with late fee and interest. Interest and late fee will be applicable. And also there are some consequences applicable for him. That is, he cannot carry forward the losses except house property loss and unobserved depreciation. He cannot claim Chapter 6A under that heading C deductions, that is income based deductions. Under Chapter 6A in heading C, he cannot claim any deductions. And even 10AA deduction, he cannot claim. That is the profit with respect to the export business operating in SEZ area, guys. Okay, sir. Then coming to an updated return, very important from exam point of view, guys, which is covered in section 139 subsection 8A. Very important, so pay attention. Yes. Any person who has already filed the returns within the due date or belated return or revised return, or a person who has not at all filed any return, can file updated return within 48 months from the end of assessment year, guys. So please be careful. This is an amendment. Within 48 months from the end of assessment year, an assessee can file updated return. Hope you understood. Yes. See, updated return means you would have already filed something. Now you want to update it or change it. That is called updated return. But here they are also allowing whether or not the assessee has filed the original return, whether within due date or not, still they are allowing you to file updated return. Got it? That means you can file updated return even if you have not filed any return before for that respective year. Okay. Then the government will allow you to file updated return only if that updated return brings more and more revenue to the government. Because of updated return, if the revenue of the government will go down, means they will not allow you to file updated return. For example, in your updated return, if you are reducing your total income, or if you are reducing your tax liability, or if you are increasing the amount of refund, they will not allow you to file updated return. Same way, if you want to file an updated return and show loss, they will not allow you to file updated return. So you can file updated return only when you want to disclose more income, more tax liability, or you want to claim less refund. Okay. So there is some conditions here. Let us see. The provisions of updated return would not apply if the updated return of such person for that assessment year is a loss return. You cannot. Then, as the effect of decreasing the total tax liability, okay, or as a result in refund or increases in the refund, they will not allow it. It will not allow. Okay. Next, one more list is there. No updated return can be furnished by any person for the relevant assessment year where an updated return has already been furnished by him for that year. Means, guys, there is a concept of one assessment year, one updated return. That's all. Once you have already filed an updated return for a particular year, for the same year, you cannot file one more updated return. Okay. Second one is any proceedings for an assessment or reassessment or recomputation or revision of income is pending. So if there is any case pending against me for assessment or reassessment or recomputation or revision, then for that particular for which assessment is still pending or proceedings is still pending, for that year, I cannot file updated return, guys. Got it? Yes. And whenever an assessee is filing updated return, he is also supposed to pay something called as additional tax. He should pay whatever tax is still pending along with interest and late fee, and in addition to that, additional tax. And how much additional tax is important, but I will cover it little later. Let me finish other topics first. Okay, sir. Then defective return covered under section 139 subsection 9. Assessee has already filed the returns, but the assessing officer has identified some defect in this return. So he will intimate this defect to the assessee through an intimation or through a notice, and the assessee has to rectify that defect within 15 days of receiving the intimation. Or if required, the assessing officer can extend the time limit. Within that time, the assessee has to rectify the defect return, guys. If assessee fails to rectify the defect in the return, then it will be considered as if he has not filed the return. as if he has not filed the return, guys. Okay, sir. Then coming to self-assessment tax. Guys, if you remember, I covered a topic of self-assessment tax at the beginning of TDS, TCS and advanced tax topic. Now, in the assessment year, the assessee will do the actual calculation, compute the actual total income, and on that, whatever is the tax rate applicable, he will apply and compute the tax liability. From that, whatever TDS, TCS, and advanced tax credit is there, we will remove it or we will deduct it. Then, whatever is the remaining amount, the assessee has to pay as what? Self-assessment tax before filing the income tax returns. Got it? So assessee has to pay self-assessment tax only if any amount is still pending or due before filing the income tax returns. And this amount will always be paid in when? In assessment year, guys. In assessment year. Okay. So self-assessment tax is covered in section 140A. What is it? We will see. Self-assessment tax means a tax paid by an assessee on the basis of self-assessment. That is, assessee himself has to calculate this before filing the return of income. The total tax payable is calculated on the total income of an assessee, that is in the assessment year. It is not based on estimation, it is the actual figures. After considering the following amount, means from the total tax liability, we will reduce all this. If still any amount is pending which is positive, we will pay it as self-assessment tax. Sir, what if assessee has already paid excess tax in the form of TDS, TCS or advance tax? Then whatever excess he has paid, he can claim it as a refund by filing the returns. Okay. So from the total tax liability, we need to reduce all this, guys. What is it? The amount of tax already paid under the provisions of this act, like advance tax, then any tax deducted or collected at source and remitted to the government on behalf of the assessee, any relief of tax claimed under section 89, or any tax credit claimed to be set off in accordance with the provisions of section 115 JD. If at all C and D might not be there always, if at all if it is there, we will reduce it. Okay. Remaining, if any, we will pay it as self-assessment tax. And if there is any delay in filing the returns or paying of tax, then there is interest under section 234A levied along with the late fee under section 234F tax, which I have mentioned here. Okay. Next, such determined value of tax along with the interest is paid before furnishing the return, and the proof of payment should be attached along with the return. And that amount, whatever they are paying before filing the returns, is called as self-assessment tax. And if there is any short payment, for example, assume guys, the assessee is supposed to pay 10,000 tax and interest of 2,000 and late fee of 1,000. Okay, so total comes to 13,000. But assume assessee has paid only 8,000. 8,000. So how do I adjust it? So government is telling first adjust the amount against late fee, then against interest, and the remaining against tax. So for example, out of 8,000, 1,000 will be adjusted against late fee first, then interest. So 3,000 gone, remaining 5,000 against tax. That means still 5,000 tax is outstanding, guys. So it has to be adjusted in this order. First this, then the last one is tax. This is only when there is a short payment. If assessee has paid full 13,000, then there is no confusion, guys. Okay, I have mentioned here. Where the amount paid by an assessee falls short, the amount so paid shall first be adjusted towards the fee payable, that is late fee, and thereafter towards interest, and the balance, if any, shall be adjusted towards the tax payable. So it goes in that order. Okay. So if there is a delay in filing the income tax return, the assessee has to pay tax along with interest as per section 234A. And how much interest? Guys, we have already learned interest under two section for non-payment or short payment of advance tax. What is the interest levied? We already learned under section 234B and 234C, where the interest rate is 1% per month or part of the month. Here also interest rate is 1% per month or part of the month, but on what amount is different. Okay. First of all, when interest under section 234A is levied is when the assessee has failed to file the return of income before the due date, or the assessee has not at all furnished the return of income. Even for belated return also late interest would be charged, guys, along with late fee. Okay. So interest is at 1% per month or part of the month. Okay. Period. Interest is from when to when? If the return of income is furnished after the due date, it is delayed, but after the due date, it is filed. So from the due date till the actual date of filing the return of income, interest will be calculated. Okay. Then no return is furnished at all. Till now, assessee has not furnished any return. In that case, due date, that is the actual due date to file the returns, till the date of completion of assessment by the assessing officer. Okay, sir. So interest is calculated on what amount? Whatever amount is still outstanding, guys. So from total tax liability, we need to reduce the advance tax paid, TDS, TCS, or if there is any credit available or relief, remove all that. Whatever is the remaining amount to be paid as self-assessment tax, no, on that interest would be levied. So let me read it. Interest has to be calculated on the amount of tax on total income as reduced by an amount of advance tax if paid and any amount of TDS or TCS, any relief under section 90 or 90A. This is double taxation relief. If assessee has paid a tax in any foreign country, he will be given a relief under section 90 or 90A in India, or relief under section 89 or any tax credits, guys. We will reduce it. On the remaining amount, we need to calculate interest. Sir, what if assessee has already paid excess amount? He is not supposed to pay any self-assessment tax, and in that case, there is no interest under section 234A, guys. If assessee is eligible for a refund for delay in filing the returns, interest will not be levied under section 234A. Okay, yes. Then, whenever there is a delay in filing the returns, there will be a late fee charged under section 234F, F for late fees. Okay. How much, sir? 5,000 will be the late fee. But if the total income of an assessee is up to 5 lakh, then the late fee would be 1,000 rupees. So if it is up to 5 lakh, it is 1,000. If it is more than 5 lakh, that is total income, then the late fee would be 5,000, guys. Got it? Yes, sir. Then tax on updated return. Very important, guys, because there is an amendment in this provision. Tax on updated return is covered in section 140B. What is it? I will try to explain you. Yeah, pay attention, people. Yes. So let us take our previous year, which is 25-26. What is the assessment year for that? Assessment year is 26-27. I will go step by step. Guys, assume the due date applicable for me is 31st July of the assessment year to file my returns. So if I file it within this date, then no late fee, no interest. Whatever tax I'm supposed to pay, just pay it. Okay. If I couldn't file the return within 31st July, I can file belated return till when? Till 31st December of assessment year. Okay. Or else, sir, I have already filed the returns, whether within the due date or I have filed belated return. But there is some mistake. Can I file a revised return? Yes. Within what time? 31st December of the assessment year. Okay. So this is the maximum deadline to file belated return or to revise the return. But after that, if I want to change anything or if I want to update anything, what should I do? I have to file updated return. And the timeline to file updated return is 48 months totally from the end of assessment year. So for us, assessment year is 26-27. So the end of assessment year is 31st March 27. So from year, assessee will have 48 months time, which is equal to 4 years to file what? Updated return. But listen here. In the law, that is how they have given. Assessee has to file updated return within 48 months from the end of assessment year. Okay. But sir, can I file the updated return even during this period? Yes, you can file it. You can file it. But maximum time for you is within 48 months from the end of assessment year. So that means from year to year, I have a time to file updated returns. Once the door for revised return and belated return is closed, the door for updated return will open. Hope you got it. Yes. So that means from year, totally assessee will get 51 months time to file updated return. But please don't write this in your answers. In the law, how it is given is the assessee has to file updated return within 48 months from the end of assessment year. You guys also use the same in your answer. Okay. But I am just trying to explain you the concept. Even within this time also, the updated return can be filed, guys. Okay, sir. Fine. And when assessee is filing an updated return, he has to pay whatever is the amount of tax he is supposed to pay plus interest plus late fee if any. along with additional tax, guys. Along with additional tax. And additional tax is levied as a percentage of tax plus interest. Tax plus interest. So whatever percentage we will discuss here, no, it is a percentage of what? Tax plus interest, guys. So come on, let me explain again. When assessee is filing the updated return, he has to pay whatever tax is still due along with interest for delay in payment of tax or delay in filing the returns plus late fee plus additional tax. And additional tax is charged or levied as a percentage of what? Tax plus interest. And how much is the additional tax depends on within what time the updated return is filed. Okay. Guys, this is the end of our assessment year, that is 31st March 27. So if the updated return is filed within 12 months of the end of assessment year, then the additional tax would be 25%. Sir, what if updated return is filed after 12 months but within 24 months, that is after 1 year, within 2 years, then it is 50%. Sir, what if it is after 24 months but within 36 months, then it is 60%. Sir, what if it is after 36 months and within 48 months, then the additional tax is 75%, guys. Any one will come, not all. Okay, it depends on when the assessee is filing the updated return, guys. Let me repeat. If assessee is filing the updated return within 12 months from the end of assessment year, then the additional tax is 25%. If it is after 12 months but before 24 months, then 50%. If it is after 24 months but before 36 months, it is 60%. Then if it is after 36 months but before 48 months, then it is 75%. And this percentage has to be applied on what, people? Tax plus interest. Very important provision because this has been amended, guys. I feel somewhere it is important for exams. So please be very careful with this. I will explain this with an example. Okay. I have given this in the revision material only. So just observe. Assume originally the assessee has not filed any return. So he has not filed any original or belated return. Now, can he file updated return? Yes. So let us take a scenario. Assume as per the updated return, the final tax liability including surcharge and cess of an assessee is coming to 15 lakh. And he has already paid an advance tax of 5 lakh and TDS deducted on his income is 2 lakh. So how much amount is yet to be paid by him? 8 lakh. Assume as there is a delay in payment or delay in filing the returns, there is an interest limit of 80,000 under section 234A. And there is also a late fee of rupees 5,000. So now he is supposed to pay totally 8,85,000 plus additional tax. Plus additional tax. Additional tax of how much? Guys, please be careful. Additional tax percentage has to be applied on 8 lakh plus 80,000. That is 8 lakh 80,000. It will not be applied on 5,000. Now assume updated return is filed within 12 months from the end of assessment year. So what is the additional tax? 8 lakh 80,000 into 25%. Sir, what if it is after 12 months but before 24 months? Then 8 lakh 80,000 into 50%. If it is after 24 months but before 36 months, then 60%. If it is after 36 months but within 48 months, then it is 75%, guys. Got it? Yes. And please be careful. I have given all the 4 options here, but obviously an assessee cannot be covered under all 4. Sir, should he pay all this? No. Anyone, guys. Wherever he is covered. Wherever is covered. So 8 lakh 85,000 plus additional tax. Any one out of this. Okay. Next, one more example. When original or belated or revised return is filed, assessee has already filed a return, but now he wants to change the figures in that, for which he wants to file updated return. So I have given an example here. Tax paid as per original or belated or revised return, including surcharge and cess, assume is 15 lakh. But tax payable as per updated return is 25 lakh. That means there is a short payment of how much, guys? 10 lakh. So now assessee has to pay along with updated return 10 lakh. And as there is a delay in payment of this, assume there is an interest of 50,000. Okay. Then there is a late fee under section 234F. If at all, if the original return itself was filed late, assume it was filed belated, then there will be a late fee under section 234F. Assume how much? 5,000. Let us take it as for belated returns 5,000. So now assessee has to pay 10,55,000 plus advance tax. Sorry, additional tax plus additional tax. So additional tax is levied as a percentage of what? 10 lakh plus 50,000. 10 lakh plus 50,000 guys. So let us see that. If the return, that is updated return, is filed within 12 months from the end of assessment year, then the additional tax would be 10 lakh 50,000 into 25%. If it is after 12 months but within 24 months, then 50% of 10 lakh 50. If it is after 24 months but within 36 months, then 60%. If it is after 36 months and within 48 months, 75%, guys. Any one of this. That is 10 lakh 55,000 along with any one of this has to be paid by assessee, guys. Got it? Yes. So this is all about the revision of assessment procedure chapter. But guys, there are few more topics covered in this chapter. That is PAN provisions, which are covered in section 139A, Aadhaar provisions, which are covered in section 139AA, and also tax return preparer. Tax return preparer is a scheme where an individual or HUF who is not able to file their returns by themselves, they can approach this tax return preparer through whom the return can be filed under the income tax law. And who can act as a tax return preparer means who is holding any bachelor degree or who has passed CA intermediate or CS executive or CMA intermediate exam, guys. But an individual or HUF who is subject to tax audit as per section 44AB cannot file their returns through tax return preparer. Why so? Because they have to appoint a chartered accountant in practice to conduct the tax audit of their books of accounts under income tax law, guys. Got it? Very simple provisions. And also, who should verify the returns is given in section 140. Okay. As these are simple topics which are manageable, I'm not covering it in the revision lecture, but that doesn't mean that you will also skip these topics. Guys, just go through it. All these provisions are given in my provisions book. Please make sure that you will go through it at least once, so that if any questions is asked in the exam, you will be able to answer it. Got it? I'm again telling, guys, I am not doing it because it is a manageable topic for the students, but please, you guys don't skip it. Just go through it at least once, guys. So we are done with this topic.